Imagine waking up tomorrow to headlines claiming the global financial system has stabilized, markets rising, currencies steady, and central banks seemingly in perfect alignment, only to discover that this stability is nothing more than a carefully engineered illusion, controlled form of chaos designed to benefit those who understand the hidden rules of money. Most people think economic turmoil is accidental, unpredictable, or caused by political conflict. But the deeper truth is far stranger. Chaos is not a glitch in the system. It's the fuel that keeps the machine running. To understand how this hidden structure works, we must travel back in time to the early days of European finance, when merchant families discovered that the more unstable a kingdom became, the more it depended on lenders. War, famine, political upheaval, none of it weakened the power of creditors, amplified it. This was the birth of the first unspoken rule: instability creates dependence. When England repeatedly ran out of money during endless wars, the monarchy turned to private financiers. And what began as emergency borrowing evolved into the creation of the Bank of England, a central institution built on the idea that government debt should not be temporary but permanent. From this foundation emerged a system where the state's strength came not from gold or land, but from its ability to borrow endlessly. As time passed and the world moved into the early 20th century, global trade expanded, economies linked together, and financial markets began to respond to each shock in increasingly coordinated ways. While it appeared that crises threatened the system, central banks realized that they could manage chaos by controlling interest rates, gold reserves, and liquidity injections, shaping the direction of every collapse and recovery. This led to the second hidden rule: crisis is leverage. Institutions created during the Great Depression and later at Bretton Woods learned not to prevent financial breakdowns, but to guide them. When the U.S. broke the link between the dollar and gold in 1971, money detached completely from physical reality and became an instrument of pure debt, giving central banks the power to expand or contract economic activity through credit alone. The rise of derivatives, global capital flows, and deregulated banking in the 1980s and 1990s created a system so interconnected and leveraged that volatility wasn't just tolerated, it became essential. Without market swings, derivatives lost value. Without uncertainty, speculation dried up. By the time the 2008 financial crash hit, the system should have collapsed. But instead, governments and central banks coordinated a rescue of unprecedented scale, pumping trillions into markets and rewriting the rules in real time. This moment revealed the final hidden rule. Modern financial stability is engineered from above, carefully calibrated to prevent total collapse while still allowing enough chaos for profit. The fallout of this design has reshaped our world. Global debt now exceeds $300 trillion. Asset bubbles form and burst with ritualistic regularity. Inequality widens as those closest to credit benefit first. And the time between crises shrinks with every cycle. Reforms are introduced after every meltdown. But none of them alter the system's core architecture because the incentives remain the same: fixes, attack symptoms, not causes, raise interest rates, and you crush borrowers. Lower them, and you inflate bubbles. Regulate banks, and the shadow banking system grows. Deregulate them, and speculation explodes. Print money to stimulate growth, and currencies weaken. Impose austerity and economies stall. Each solution plants the seed for the next crisis, making controlled chaos not a flaw but the operating system. Today the pattern repeats. US debt rising by over $1 trillion every 100 days. Central banks owning massive portions of their own bond markets. Nearly 70% of global currencies tied indirectly to the dollar. And 40% of all dollars in existence created in a mere 18 months. These are not signs of stability. They are signs of a system surviving through engineered pressure, expansion, and intervention. Every cycle follows the same sequence: expansion, over-leverage, panic, rescue, relief, repeat. And each time, power consolidates further into the hands of the institutions that manage the chaos. The lessons are clear. Financial turmoil is structural, not accidental. Crises strengthen the very institutions meant to prevent them. And the true rules of the system are written in incentives, not law. We are living inside a financial architecture that cannot simplify, cannot deleverage, and cannot function without volatility. Chaos is the engine, and we are passengers inside a machine built on controlled instability. If you want to continue learning how this system operates, the patterns behind global crises, and the hidden forces shaping the future of money, make sure to subscribe, like this video, and turn on notifications, because the deeper we go, the stranger the truth becomes.